sample data. So try to download this one. And later this week and next week we'll cover a volatility model. So I uploaded that part as well. Okay. So today we'll try to cover the rest of the stuff in lection 2. That is forecasting first. Before I show that, let's see. It's written in Korean, but let me explain briefly what it is. Last week, Federal Reserve had an open market meeting, FOMC. Their concern was, and also market's concern was, when this reduction of this kind of policy will start. Currently, starting from September 2012, they started purchasing $40 billion worth of MBS, which is bond. Also, starting from January this year, each month they purchase $45 billion worth of long-term treasury bonds. The meaning is they purchase bond, FRB purchase bond, so it will circulate more money in the market. That's the idea, but you can't do that. You know, the United States owns printer; they can print money. Often, emerging markets like us, we worry about foreign reserves, dollars, euros, gold, but we don't have any printer. We can't print dollars, right? They can. US can. They can do it, but they can't. It says their policy will last indefinitely unless particular condition is met. So one thing was they will start reducing this type of policy if unemployment rate reaches the target rate of 6.5%. Last month is about 7.6%. And also, if inflation rate is not exceeding 2.5%. Currently, I believe it's about 1.7. So, what was the decision last week? They say it's not right time to lift this kind of policy. They will continue to this one. Of course, their option is FOMC meeting. They scheduled 2 more meetings this year, October and December. So they'll take a look at market condition again and then decide. The reason why I brought this issue is that, well, when you make this kind of big policy, when they actually started this policy last week, then many of our government officials have to stay in office, not going to home. Right? Because we expect a lot of uncertainty, and our economy is going to be greatly influenced by the policy. But the decision was to stay put. So for the time being, this policy will continue. So $85 billion worth of government bond purchase will continue each month. before I see the press conference last week, I had to make this slide, which is supposed to be presented 2 days later. My job was to make a best guess about what's going to happen and to prepare some policy in terms of this manual for the economy. So the thing is, currently unemployment rate is about 7.6%. Then you might want to know, or you might want to project or forecast unemployment series, so that you can see that with a certain level of confidence, you can say, well, it will reach to that target level by December this year. Would that be helpful to policymakers, or even to the world economy as a whole? It's a big question, $1 billion question, I think. How about this? So the main reason why Bernanke didn't make big move this time was he still believed that the economy, U.S. economy, is not growing that fast as expected. So what we'll do is we'll try to forecast U.S. GDP up to hopefully mid next year, and see if whether the condition for that kind of policy is feasible. So forecasting is very important in economic decision making. So this is the example of forecast. I mentioned previously that the price earnings ratio is typically stationary time series, which means having constant mean, constant variance, and constant covariance. So suppose this is your last observation, and then these are forecasts. And I also mentioned P ratio is best fit as a autoregressive model of order 1, very simple one, and mu is long-term average. The principle of forecasting we learned last time was to calculate forecast as a conditional expectation if this representation is correct. So if this representation is correct, then the conditional expectation will give you best forecast in terms of mean squared error. That gives you minimum mean squared error compared to the competing forecast. So if you are at time t, all the values afterwards can be computed by operating conditional expectation operator on both sides, right? So this is actually what you can do. If you can do it. Actually, it's very easy exercise. Several things I'd like to mention here. If your data ends at this point, and we say these are in sample and these are out of sample. In sample period is the period that is used to build a model. Of course, if your model is really a good one, then it should be able to explain in-sample variation. Right? And also, if your model is good, and also if the structure of the economy is the same, then your forecast has to be also good. So in sample and out of sample. But mostly, what we are concerned is out of sample forecast ability. So we get to a measure that can be used to determine which model produces better forecast shortly. Okay, now another term here is these forecasts are conditional expectation. Expectation is on average, right? Whether it is conditional or unconditional, it's average. It's in the middle, right? So most of the time, your bet would be this path. But with probability, sometimes it could be higher or lower than average forecast. So you need to assess the uncertainty. Here, I plot one standard deviation band here. If you look at this page, you are at cap T, and this is K period of bad forecast. So in terms of graph below, this is one step ahead forecast made at cap T. This is two step ahead forecast made at cap T, right, and so on, right? So information you use is up to cap T. So of course, you can calculate any K step ahead forecast at cap T. Now, in notation, this is actually conditional expectation. So, meaning this path. And then you can add or subtract 1 time standard deviation or 2 times standard deviation band. So approximately 2 times standard deviation band is about 95% Thompson's band. How to calculate that? Well, try to calculate one step ahead, for instance. So actual one step ahead forecast and actual value, that's forecast error, one step forecast error, right? If you can calculate one step ahead forecast errors variance analytically, actually you can do that. So the way you do it is, if K is 1, what you do is you calculate one step ahead forecast, and then compare that with actual one, and then move forward, and then generate one step ahead forecast, and compare with actual one. So you keep doing that. And then you can evaluate what is, because this is random and this is something expected. So this is number. Expected value is number. This is a random variable. So this has to be random as well. If something is random, then you can calculate the variance. The expression is messy, but certainly you can do it. If you are making 2 step ahead forecasts, you can do a similar thing. You can generate those 2 step ahead forecast error, and then calculate the variance, and then you can apply this to set up this confidence band. But the thing is, if you actually calculate this one analytically, and let me go back. 1 step, 2 step, 3 step ahead forecast in this case, not going forward. So you are making a forecast at cap T, you want to establish this one, but to calculate this number and number below, you need the variance or standard deviation for in cap T1. To calculate this number, second number, and below, you need a variance of ET2. So you can do it actually algebraically. What happens if K increase indefinitely? So your forecast horizon is very long into the future. Well, usually what happens is the uncertainty tends to rise if you are looking into the future. Right? So the location of these values is more uncertain if you look into the future, right? But the uncertainty won't be increasing, infinitely, because this one is assumed to be stationary time series. So it has a long mean. So what is the forecast, let's say, after 100 years, very long time in the future? Well, probably you don't know exactly what's going to be, but your best forecast is going to be still, it may be around the average. Well, is it very uncertain? So the band is infinitely high and low? Not likely, right? Because it's stationary time series, the band of the variation is limited, is bounded. Right? So even if you're looking at 100 years from now, still the band is expected to be contained. Right? So if you actually derive this one as an analytical formula and let K go to the infinity, still you can get some number, this number, initially increasing but stabilized. The band gets stable. That's the feature stationary time series exhibits, which is dramatically different from the forecast and its constant and the non-stationary time series, which is presented below. And the other thing before we move to the next slide is the method called bootstrapping. Actually, you can calculate future paths of YT analytically, as I said, or if you estimate this one, probably you will get the estimate of this one, which is the variance of residual term. And it is assumed to have zero mean, right? Suppose it is generated from normal distribution. Normal distribution. And if you are given an estimate for pi mu, and if you are willing to make this assumption, then it's easy to generate value, random value next period. Because you have value at t here, all knowns, and then because you assume this property, you can draw t plus 1 from this distribution, assuming this is correct distribution of ET. So put it in, and then you get this one. Right? So this is systematic part, and this is random part. So it makes it random. So if you get this one, plug it in again, and draw another number, and you get t plus 2. Right? So you can generate single path up to k step ahead. Right? So suppose you are at t. This is a, sorry, usually going this way. The path would look more like this one. It's not going this direction forever, right? Or that direction, because it's stationary time series. Right? Because the absolute value of this one is less than 1. Then if you cut a particular point, suppose you did that exercise 1,000 times, and take the average of 1,000 observation at a particular point. That average, like this one, or if you look at other similar thing. And the result between analytical solution and if you sort 1,000 observations from the highest and the smallest, and if you read off, let's say, 2.5%, not 2.5%, and that will give you 90% band. So if you keep doing that, that will look more like this. So that's the calculation of forecast and its constant span using simulation. The method I just described is called Monte Carlo simulation. And by Monte Carlo simulation, what we mean is we are assuming particular distribution. Okay? So if normality is the proper assumption we would like to make, then the procedure is valid, as valid as the analytical calculation of forecasting span. But as you will see later from Korean GDP growth rate series, usually this is very difficult assumption to accept, because sometimes we observe GDP growth rate which is very much smaller than what this usual normal distribution implies. So the alternative way of doing it is called bootstrap. Procedure is like this. Suppose you estimated this model. And of course, when you actually fit this model, and then you can, given these parameters, you can calculate this one. That is what is called fitted residual. So if your sample is, let's say, 1,000, then ET sequence is going to be 99 of them, right? Losing one observation. Right? So you have 99 residuals in a vector. And what you can do is, because each number, 99 numbers have a time record, right? 1, 2, 3, 4, up to 99, right? So you draw random, in a random fashion, from that 99 observation in a urn. So draw one, pick, and use it as proxy for this one. And then put it back. So keep ET, total number of ETs as 99. And then pick another one in a random fashion and add it to get forecast at t plus 2. can keep doing it, right? So the procedure is exactly the same as Monte Carlo simulation. Only difference is Monte Carlo simulation, you make particular assumption about the distribution of residual term, whereas bootstrapping method, you are treating fitted residual as a population. We don't know which distribution, but we treat this one, nine numbers, as a population of particular distribution. So if our observation yt historically contains some number like this one, these are hardly drawn from normal distribution. But if we treat this one as population, with very small probability, you can actually pick this number. So when you are not sure about the distribution, which is usually the case, you better stick to this. Okay. So in eViews, default is this method. Of course, you can ask eViews to calculate analytical forecast that is banned, but that's a simpler way of doing it. So I'll show you that later. Okay, this is in contrast to previous case, where if you have stationary, so non-stationary time series like natural log of S&P 500 stock index, you model it in a particular form. Let's say take first natural log of stock price, which is non-stationary. Take first difference, so make it stock return. And then identify these numbers, P and Q, using those information criteria. So suppose you estimated 110 model. The final model. Well, if change in this stock price index is natural log is y, and if it is modeled as AR1, that's what this is, right? In terms of this guy. And also, this is just simple difference operator. So if you know previous one, and if you know growth rate, then you can calculate the next value, right? You can continue to do that. And then when you calculate this one, like that, and then later you can exponentiate it to obtain original value. Right? So this is the result from that exercise. It says forecast field is to an optimistic direction and the band. But as you can see, the variation gets wider, right? This is non-stationary time series. So if your forecast is that way, what is the accuracy of that forecast? It's going to be wider and wider. So by the end of next 30 decades, we can say cost P is going to be 10,000. And what is your uncertainty? Plus minus 2,000, 20,000. So it's not going to be bounded, not going to be stable. It's going to continue to increase. That feature can be shown. Actually, if you look at, if you read a higher level time series textbook, for non-stationary time series, if you calculate this variance of forecast error, and if you let k goes to infinity, it's going to blow up, continue to rise. Okay. I'll show you a few more things and then we'll get to forecasting exercise. Well, we'll discuss this one in chapter 4 of textbook in our lecture on 4. Actually, there is a formal test for the presence of non-stationarity. We call it, the simplest version is called augmented Dickey Coulomb test, ADF test. The setup is like this. First of all, let's think about the process for xt. Take first difference and run a regression of first difference of xt on constant and its lag, but not the difference, instead original level. And for the time being, forget about this part, and then redo. So if you run a regression of this one on constant and lag level, suppose what happens if rho turns out to be 0? Rho turns out to be 0. That means xt, not delta xt. Xt equals to mu plus xt minus 1. Okay. So it has unit root, which is non-stationary. So ADF test amounts to testing this one. And if you find this value, 0, statistically 0, then we say x of t is non-stationary. And usually, if you find a negative value, small negative value for rho, then that's the case of stationary concept. The reason why this one is a little more complicated than usual inference procedure in standard econometrics is that, well, you can estimate this coefficient, this intercept term and rho using least square. And you can calculate t value, t statistic, and test whether, you can test whether rho equals to 1, sorry, 0, using standard t statistic. But there is a flaw. So we'll discuss in more detail there. But the thing is, when you try to test this one in this kind of situation, things are a little bit more complicated. So usual t statistic is okay. You can calculate that for this estimate. But you shouldn't refer to standard t distribution for your inference. So later it will turn out that t distribution with particular degree of freedom, it is centered around 0. Okay? symmetric, right? So if your t value lies here or there, so far from 0, then you said there is an evidence against the null hypothesis, right? But later, if you calculate t value for this problem, it will turn out the shape of the distribution on the null hypothesis will look more like that. So something that would have been significant on the standard t-distribution may not be significant in this non-standard distribution. So we will get to that part. So for the time being, you can remember that, well, there is a formal test, and the test name of the test is augmented decay-polar test. And test is for checking whether this coefficient is 0 or not. Sometimes the original version of decay and polar test was to look at up to this point. Or sometimes you include time trend variable. Time trend variable is such a variable that has increment of 1. Right. So that's the original decay-polar problem. But later, other time series equalization says you better add those lag-dependent variables up to several lag that will make this test more stable or valid. Probably you recall the meaning of conditioning something, right? When I talk about partial correlation, I talked about the concept of conditioning information in regression. Right? So obviously, if there is a more serial correlation in process X, and if you don't consider those as a conditioning information, without these terms, the estimate of this one or this one or whatever would be biased. So that's the reason. So augmented is the extended version of decay-polar test. Okay, in summary, this is the model, typical macro or variable or financial time series. As I said, YT, usually we use natural log of something. Natural log of real GDP, natural log of consumption, natural log of stock price. Why? They are usually, if you apply that kind of decay-polar test or augmented test, they turn out to be non-stationary time series. So first step, it is explained later too, is to take first difference. So setting d equals to 1. So d equals to 1. That's typical economics and finance application. So 1 minus L and something makes this term as return or growth rate, which is usually stationary. And then follow usual, so calculate this quantity first. Because if you have data, then you can take simple difference. Right? So this is the data part. And the modeling part is to determine P here, the order, in pi polynomial, and Q, which is the order of theta polynomial. Okay. Using which information? Information criterion, Akaike information criterion, or short criterion. So try different PQ combination and try to pick combination that yield smallest information criterion. Okay. Obviously, if d is 0, and that means this thing is 1. So the y itself is stationary. Okay, so we'll try to see this part before we see actual Korean GDP data. This red line is the GDP growth rate for this period. This is quarterly GDP growth rate. So to obtain this particular value, I first take natural log of GDP series, quarterly series, and take the difference using adjacent observations. So this is quarterly growth rate. So on average, quarterly growth rate is about 1% or 1%, slightly above 1%. So if you multiply that by 4, then it's like 4.something% annual growth rate. This green line is the fitted value. So if you estimated some model like this one for GDP growth rate, and this part, fitted line, is green. And then the difference between these two is plotted here, which is this one. Okay. Okay. Now you can see there are two big spikes. So you have to think about whether these are in fact something called outliers, or sometimes you can hardly tell. But when you actually look at the data, and if you look at the data before and after year, let's say 2000, the average is slightly higher here than the later period. So we say that kind of thing is structural growth. That's a possibility. Or sometimes you see there could be AR1 process, so non-zero pi for Korean GDP growth rate, but after some period, this value is not constant, so it could be smaller. What I'm saying is this could be also time varying. So, of course, that's a very difficult problem to solve for the time being, but there's no guarantee that the value pi is stable over the whole period. So all those issues has to be checked. Think about our first PowerPoint slide. You're going to make big decision, and you're going to generate your own GDP forecast. The world is watching you, and you want to prepare your answer. So the question from floor is about how did you handle this part, that part, that part, that. So anyway, this is the case. So the one way is to introduce a dummy variable for this kind of episode. Actually, this is the period of 97 currency crisis in Korea and 2008 global financial crisis. So we know that, well, we are having this kind of episode. Actually, in 2003, we had recession here too, credit card crisis. So we have crisis every 5 years. So that's kind of something, some people may say is repeating. But to many, these are outliers. It's hitting hard, but it's temporary. Lasts quarter or two, and then disappears. So in that case, if you interpret it that way, then you can treat that problem using dummy variable. Dummy variable look more like this one. You take values 1 during event period. So in this case, I assign 2 quarters, so first quarter and second quarter of 1998 as a outlier. And the single, I believe this is December of 2008, the fourth quarter of 2008. So probably adding these two will solve that problem. Okay, so let's go to actual data. So this is real GDP data. Up to, so this is billion, so I think my sample this particular sample ends third quarter of 2012. Of course, we can extend it. So when you extend this kind of data, try to compare your new data for some recent data as well, because there is a constant revision in this figure. So when you're here and try to bring just 3 observations, then actually if you compare your new numbers and those records, probably will be slightly different. So try to replace it once and for all. Here is my plan. I have the data up to, in this case here. But the plan is I pretend my data ends here. So in sample ends first quarter 2010. Why? I tried to reserve those to compare the actual with my projection. So usually you are very curious about your forecast and actual. But if you are building the model here and try to project it, but don't have an actual, then you have to wait until. So this is usually the way we divide the sample. In sample and then out sample. So first, I like looking the data in natural log. So previously it was billions of Korean wons, constant dollars, but this time this is natural log. The reason why I see it is this way, is if you have plot in natural log, then the difference between 2 observations, there's a growth rate between these 2 periods. So actually the slope is the average growth rate. So as you can see here, 2000, it has been steeper than. Also, you can test it using formal test scheme, but visually appears that we are getting to the slow growth stage. So later we can consider that part, but without that, GDP growth rate is the one I calculated here as by typing series GDP-GR equals to 100 times log difference. This is log difference function. So original series is taken natural log and taking first difference. And then times 100, that makes this as a quarterly growth rate. Right? So to make it annual term, then multiply 4 by 4. So at this point in time, second quarter of 1990, growth rate is about 2%, right? So if the economy grows at this speed for 4 years, then it might be 8% growth, slightly less than 8%. That's what it is. If this is the case, then as a third quarter, your annual growth projection is very high. Okay. Now, first thing is visually check hologram. And I use all the sample. So the data all the way up to both in sample and out of sample, the whole sample. The third quarter of 2012 is used, and as you can see, partial correlation is significant at lag 1. So if you are estimating equation, GDP, GR, C, and let's say AR1. And let's use sample up to 2010. Because the first order partial correlation is significant, as expected, this one is significant. So using your in sample, this is the result. And if you try this AR2, doesn't seem to be significant, right? So you try these different combinations, including moving average term, then check this correct information criteria, or this one or that one, but pick one and compare and pick the model that yields smallest information criteria. So it will turn out that this is reasonably good model. And when you estimate this one, as I said before, check whether these numbers are significant individually and whether there is a portion being explained by the model. And obviously we check this part. Right? And also check view actual fitted residual in graph. So this is what you've seen previously. Right? So if you're comfortable with this, well, if your model is reasonable, there shouldn't be any, or regressive movement or moving average movement. Right? This all has to be modeled by this systematic part. And residual is expected to stay in this 1.96 minus 1.96 band, which is 2 standard deviation band. So sometimes, it lies outside this band. Right? Outside. The question is, this appears to be too big. So, as I said, dummy 97 is the one that takes value 1 and 1 for these two quarter. So what I did was, by examining when is this, right? When are these? And did here, let's say, first I define it as 0, okay? 0, and bring this one on the screen and press this, so I can edit these numbers. So what I did was I suspect these are outliers, the period including outliers. So here I type 1 and 1. So I edited this number, right? And then press it again. Then I exit from edit mode, right? So I created this one there. There. So that's the way we do it. So given dummy variable, press this one. Pressing this estimate button will bring you this estimation equation dialog box, right? So you don't have to retype things. So here, instead of stopping right there, I can say name was D97, right? That was the name. So D97 is included. Do you see that? This one is negative and significant. How about AR1 coefficient? It's smaller. P-value is smaller. P-value increases from very close to 0 to 0.098, almost 9.86%. So saying this is insignificant number at 2 standard band. So check it again. You see that it disappeared, that part. So what dummy variable did was, dummy variable is the value of 0 and 1 and 0. So 1 is positive number, and coefficient to that dummy variable was negative, big negative. So making this kind of this adjustment. So dummy variable is explaining that spike. And then here, because we didn't treat this one separately, still there is a big spike there. So this dummy variable is the one having this as dummy period and this as dummy period. So you can designate D97 as dummy displaying this part and separate dummy D08 or 0 except this one. So you can include two dummies, different dummies. Or you can include single dummy variable where you have this. So that's your choice. But if you are including these two episodes in a single variable dummy, then you will have one estimate. So what I'm saying here is, because this coefficient is the same for first episode and the second episode, right? So adjustment will be the same. If you want to make the adjustment slightly different, because the first one appears to be more significant decline in output than the second one, right? Then add different dummies. But in any case, if you do that, this follows and this follows, right? So this look much better, I think, than the previous one. But the consequence is, see this significance all damaged. If you try to estimate MA process or ARIMA combination, probably you won't be finding any coefficient significant. That means for log GDP process, this is 1, 0, 1. Oh, sorry, 0, 1, 0. Zero, 1, 0, we call it random. So now you have to estimate or forecast drunken sailors' future footsteps. So that's why it's very difficult to predict. So of course you can forecast it, assuming this is correct model. Okay. Two things happen in this case. One is by pressing this one, you are calculating analytical forecast. Analytical one. And also, when you include dummy variable, so dummy variable is 0 and 1s. But if you try to forecast in the future, because if there is a autoregressive process and even random walk process, you can calculate future path recursively, right? Using simulation, Monte Carlo, or bootstrapping. But the dummy variable is not usually defined. This is exogenous variable. Exogenous variable. So if your sample ended fourth quarter 2010, and if you created dummy variable up to that period, and if you try to simulate future path, well, GDP without dummy could be simulated, but the future value of dummy has to be available if you want to put this one as part of the model. So usually the way you do it is, if this is your in sample, there's an out of sample, and suppose you want to generate up to this point. Okay. Then first reserve enough period. Okay. And when you define dummy variable, define it all the way up to that point, not up to in sample. Okay? Because future value of that requires the value dummy, even though it is all 0. Okay. So, another thing, because you already transformed the data into GDP, GR, the growth rate, so it is already in the form of natural log of GDP in first difference. But usually you are interested in this one, right? So focus this one. And currently what we have as a candidate final model is PDQ equals to 0, 0, 0, 1, 0. Even if you say it is 1, 1, 0, it's fine. You know, even if you call it 1, 1, 0, it's fine, because this number is small, insignificant. So your forecast won't be affected that much by including this AR1, which is insignificant. So in this next practice, what I try to do is I just keep this coefficient as if this is the number, and not set equals to 0, and see if what happens. That should be trivial. Okay. You can try that with this quick and estimated equation, but let me do it in this way so you can see exactly what's happening. Least square, so sample, the sample, first quarter of 1990. So you can adjust the subsample by pressing sample and setting new sample period. You cannot exceed this range, okay? But within this range, you can make it shorter or longer. So this is changed, right? So default is this one. So least square. First, let me handle this one. T log, original data was YT, right? Original data was YT. And C, AR1, but before we move there, dummy there. Okay. Enter. So basically same result. Same result. But now the difference is not GPGR. This time, this is actual data. And first difference in natural log. So that takes care of this part, PDQ, in the middle, D part, 1. And this 1 is this one. And there is no moving average specification, so this is 0. So suppose this is the in-sample fit, and you are happy with the residual, okay? Then instead of pressing this forecast button to calculate simulation path, try this one, proc. And here we move along here, make model. So this is your model. So what it did is, if you double click this one, it says your model looks like this. So d log yt has constant mean and this times dummy variable. This one. And then it says AR process. So when I ask you how to interpret this result, well, then I see very different answers every time. So what this did is non-zero mu this is your average. Do you recall that? This mu was previously this one, right? But because you have another term here, dummy times coefficient, but that's not a regressor. What that did is to make it this one. And then there is actual growth rate and the deviation. This deviation, those deviation as they are the one coefficient. You see what I mean? So people occasionally forget the role of dummy variable. Dummy variable is temporarily adjust this long average. Right? If this is considered as outlier, you specify, and then return to normal, and then outlier. And the difference between actual and that long average is modeled as AR long process. Okay, so this is your model. So what I did was proc make model and got this one. And then if you look at this menu here, solve. This will do your stochastic simulation, and default is dynamic solution. Solution sample is, so this is to where you specify out of sample period. So out of sample period is next quarter, right? First quarter, that, let's say Q, that's right, 2013 Q4. And if you don't set anything else here, the default is the bootstrapping method. And let's see what this does for that. This bound, this one. So this one will create this upper and lower bound. Okay. And if you look at the stochastic option, by setting 0.95, you create 95% upper bound and lower bound. If you set it as 0.50, you create 50% bound, which is this narrow one. So let's try 50.50. And as I said, stochastic, dynamic solution. By dynamic solution, what we mean is the future value of GDP is replaced by your multi-step ahead forecast. Right? So you are still at cap T, okay? And then you are calculating K-step ahead forecast. Then in the meantime, the value in between is the one you simulated, right? So not using actual. If you happen to use actual value, then static solution is arrival. Here, this and out of sample period has to be specified and bound and go. Okay, so by doing that, this one is created. This one is the mean path, average path of 1,000 simulation. This is lower path, upper path. The one with S, that means the standard deviation of forecast error at 1 step ahead, 2 step ahead, 3 step ahead. That's a standard deviation. So, see, if we have many paths here, you can calculate average, right? The 95% band, and also the average. So if you compare average value and some other value, you can calculate standard deviation, right, of this 1,000 observation. So you can calculate that one. That one is stored in this one. So you can grab this actual, upper bound, lower bound, mean at the same time as a single graph. See? Because we are using all the way up to fourth quarter of 2010, there is no value for this one, right? So to see rest of them, sample. Let's make it 2, 3. Oops. What happened? Did I do something wrong? Quick check. Oh, don't have data here. Okay. Don't have data. So let's make it. Assume that we know these values, just in case. So I have all the value of forecast horizon. Let me make model. So stochastic. Says it's done, right? Because previously dummy variable was not defined up to the focus horizon, right? So it stopped and didn't store any output. I failed this one. I didn't check whether data dummy variable ended right there. But I think this will save your time more than a day, I think. and actually try to do this one by yourself, and very difficult to figure out that the problem was caused by dummy variables, undefined. So anyway, up to here in sample, and out of sample is up to there. But depending upon your purpose, you can simulate average forecast all the way up to anything future. Upper bound, lower bound. So if you view it in a graph, that's basically what it says. Pretty much off, right? So this is your projection, and this is your actual. So something must be wrong, or something must be specified in reasonable fashion. So we try to fix this problem and see whether we get the result. So this one was previous forecast. This one. And that one is very different from what you see from the screen. Right? So that's very difficult exercise to come up with a reasonable forecast, but we get to that part. So let me finish up class here. When we come back next time, there are a few more things. These are things about comparing different forecasts from competing models. Mean squared error, Granger-Newbold test, and here Diebold-Mariano test. And then some of the things like how to get rid of or remove stochastic trend from non-stationary time series. But they are small part. So when you come back next time, we'll take a look at this GDP forecast again. And then here is a what is it? YT-US. This is US GDP. Okay. So you can play with US GDP, and data ends up to second quarter of this year. So they are pretty much concerned about whether you go this way or that way, obviously, right? So hopefully we can play with this one. This one, real housing US. This is the housing price of US market. So people are interested in seeing whether this housing price is recovered kind of long-term trend, or overvalued or undervalued. So depending upon you are drawing some line like this one or that one, or different trend, you have very different answers. So these are kind of highlight series these days that requires further modeling and analysis. This is US mortgage rate. The reason why there is the extension of QE3 was to keep this mortgage rate low. Otherwise, if it increases, then the recovery of the housing market is going to be suffered. So these are all very interesting time series requiring modeling. So next time we'll get to those exercises. But this is basically the data set I uploaded this afternoon. So hopefully you can play with it before you come to class next Thursday. Okay. Any questions? think that ups and downs are kind of natural dynamics of business activity. So just having this typical model is okay. We don't usually put a dummy variable for expansion, a dummy variable for
This is just an example. I mean, if we have certain outliers who see the abnormal behavior in the data, can you create the multiple level
Of course, yeah. As I said, you can have like dummy variable for particular events, noticeable events. I know why our forecast missed that much this afternoon. If I give you the answer, clue first, as I said at the beginning, I mentioned there is a tendency that growth rate is much slower after 2000, right, compared to early periods. But the thing is, because I treated the whole period as a single regime, single structure, and allowed just two period of episode as a outliers. So the overall growth tendency is set to the single one. So so the growth rate is going that way. So when I introduce later a regime change, Fahim mentioned, like trend growth rate is much slower during 2000 and afterward. Then if you include that extra dummy variable, then our forecast will go this way. So of course, yeah, if you believe that there is a structural change, and by testing, applying child test or Q-sum test or recursive regressions, if you believe there's a change, of course you can include those separate dummies or structural shift dummy, shift down dummy. Any other questions? So the GDP forecast, this is intentionally made wrong forecast, unreasonable forecast. So don't be disappointed. We'll correct that next time, okay? Right. See you next time. Thank you.